an international American multinational food and beverage corporation, and we have our headquarters in New York. We have presence in close to 200 countries, and our products are not just limited to drinks, but a lot many more products. Today, we are going to present you about the financial analysis of PepsiCo Limited. My colleague Rohan will continue forward.
So talking about the first aspect as to why an investor is interested in any company, so we would like you to take through the profitability of the company. As you can see, the profitability, we have why there is a rise in even if you see there is a rise in long-term liabilities, the share capital is the main reason for that was the share capital was greater in comparison to the increased PAT for the year 2010-2012. So we have calculated ratios which have been increasing. As I said, from 2009, in 2010 there was a dip, but since then it's been on an increase. The equity has been increasing, so that's a good sign. The retained earnings have been, the profits of the company have been increasing every year at a constant rate. The return on investment is something which is very important for every shareholder. So there has been a steady increase in the performance of the company. The equity has increased with the issue of shares in 2010 particularly. The company has maintained a steady progress after that. The long-term debts have increased in 2010. The ROTA, the rate of the return on investment on total assets, as how we have calculated, has been again on a steady increase from 2012-2013. Talking about the liquidity of the company, I would request my colleague Siddharth to take it forward.
Hi, Mr. Venkatesh. Talking about the liquidity position in the company, it's relatively stable now, and it's rebounded after the slump in 2011, and this has improved at the back of cash and cash equivalents owing to strong cash inflows from operating activities. And the proportion of stock and inventory as part of the total current assets over the years, and the cash and cash equivalents constitute a major share of the total assets now. So that gives us, reinforces some confidence in the liquidity position of the company. And if we are to analyze the current liabilities in greater depth, we'll see that the short-term debt has, which increased in 2011, it's become fairly stable now, and the accounts receivable, which formed a major part of the current liabilities in 2009, has reduced, and the share has come down. So this has actually happened both in terms of absolute number as well as the share of current liabilities. So I think we talk about solvency now.
Yeah, hello Mr. Venkatesh. So now I'll give you an overview of the solvency position of the company. As you can see, the debt by equity ratio has been increasing from 2010. So this is because the company has been taking long-term debts to invest in emerging markets like Brazil and China. So though the debt to equity ratio is decreasing, this is because of our investment position in the new economies. And also you can see that the interest coverage ratio is also decreasing. This is because our long-term debts have increased, and we expect that our investment in the new markets will bring us new growth opportunities and increase in retained earnings. So this should not be a problem in the future, but we expect to deliver more added value to our investors. Now I'll ask Rohan to take over EVA analysis of the market.
Thank you. So talking about the DuPont analysis, as I said, there had been a slump in 2009, but from 2011 onwards, the company has increased its leverage as long-term debt component of the capital employed has increased. Profitability, as Mr. Siddharth said, has rebounded after touching 5-year low in 2011, which has come back, at the back of financial assets from long-term debt sources. from 2012 to 2013, we did the deep analysis to understand as to how the company is increasing. There we realized we understood that the OPEX, the operating costs have reduced. We have been able to do that, so that the tax burden has neutralized, which has the effect of leading to a slight increase in profitability. The cost of capital, in talking about the EVA, the cost of equity was around, the beta factor of equity was 0.37 and the market rate of return is around 7%. The cost of equity of the firm stands at 4.31%. The cost of debt before tax is 2.75%. This covers the long term and the short term debt. It's the median or the average of that. The capital charge was 12,325 million and NOPAT was 6,045 million. So the economic value addition to the firm is 6,280 million. The shareholders value had gone down to a negative. Talking about the EPS had increased because of net income decrease in the shares, and to mitigate that we have been doing buyback of shares also. To the weighted average number of shares have been decreasing year on year due to the buying back of shares. So as a result of that, the equity has increased. The company has initiated a share buyback. As a matter of fact, the equity has increased owing to the increase in retained earnings. Dividend, as you can see, there has been an increase in the dividend. In talking about 2013, 6.5 billion was paid to the shareholders in terms of the dividend and combination of share, buyback of shares that was done. That was the cumulative 6.5 billion that was given to the shareholders. Talking about the PER and PBR ratios, it's slightly lesser than the industry standards, but we are pretty steady on that term. So the PER and it's very much similar to the industry standards of 2.5 for the PBR and 7.6 for the PER. So that's from our end. If you have any questions from then you can ask.
Thank you very much. I really like the presentation. I have a few questions from my end. You gave me a lot of ratios, all those stuff. Can you just give me 3 good reasons why should I invest in PepsiCo? What makes it a great destination to invest?
So three reasons that we can think is, first, the PepsiCo has reported 7% year-on-year growth in earnings as compared to Coca-Cola also, where in all, how PepsiCo is different than its competitor. It has 22 brands in general, which generates more than $1 billion in sales per year. So that is one of the major points, that it has diverse brands. So if any one brand goes wrong, it mitigates the loss and still makes up for the profits. That's one of the strongest reasons. About 50% of its revenue is generated from international sales. So that shows the reach of PepsiCo all over the world. Considering the soda sales that have gone down recently in US, that's a positive trend for Pepsi going beyond United States and all other countries. So that's a good thing for Pepsi. Then there is one reason.
Yeah, one of the main reasons that is for your safety of your money. If you would look at the Z score of a company, it has never been below 3. It has always been above 3, which is a very secure zone to be in.
Can you throw some more light on the Z score, please?
Okay, as you are already aware, Z score is a formula for predicting bankruptcy. It takes in many factors in consideration, such as total assets, current liabilities, your retained earning, your net sales, and your market capitalization. And then it comes up with a score. And the score ranges are such that if it is less than 1.81, it is a risk score. And if it ranges from 1.81 to 2.99, it is in between, not a not a safe but not a risk also. But if you are above 3, if basically above 2.99, then you are definitely in a safer zone. And Pepsi has always been in a safer zone. If you will look at Z score, it has always been above 3.25, never been below that.
Okay. Just a last question. I saw all your ratios. I see there's a solvency risk from 2010. All other ratios are fine. Can you just explain that deviation?
Yeah, as I told you earlier that we have been taking long-term bets to invest in the emerging economies like Brazil and China. So we have been seeing positive growth in those markets, and as you can see, our retained earnings have been constantly increasing. So though we are taking debts, which is increasing our debt to equity ratio, but our retained earnings are also increasing at the same time. So we are pretty sure that we will be able to handle the situation in future.
To add on Mr. Venkatesh, despite leaving all the financial factors, I would also like to tell you that PepsiCo is one of the leading brands which has big CSR initiatives, and we work towards environment a lot, as logistic and products are a part of our lives, and that is what we deal in. So packaging, waste and recycling are something we are very focused upon. So by investing with us, you are not only getting your revenues increasing, but also you are doing your part for the environment. So it's like two shots in a one.
Yeah, that's nice. Yeah, I think that's about it, the questions I have. I really like the presentation.
Thank you.
I'll get back to you guys in a couple of days after meeting with some of my senior management people. Thank you.
Thank you.
for
Thank
Good
you.
to have you on board.
Thank you very much.